Employment benefits, IAS 19. Okay, so when we say employment benefits, what does it mean? Let us look at brief explanation to what employment benefit is. So we say that employment benefits are all forms of what? Of consideration given by an entity in exchange for what? For service rendered by what? By employees, or who? Or for what? For termination of what? Of employment. Okay, this is what? Brief explanation of what? Of what employment benefit is. So if you are an employer and you work for an institution or you work for a firm, surely you need to be what? You must be paid, right? So you earn your salary or wages, and there are other fringe benefit that comes with what? With the service that you render to the employees, the service that you render to your employer. That is what employment benefit simply means. The service that you render, you will enjoy what? You will enjoy what? The benefit out of it. So if you enjoy benefit out of it, how do we account for it? All right, so that is what IAS 19 is all about. Let us look at the objective of what? IAS 19. So objective of IAS 19, we have two objectives. We have two objectives. That's what IAS 19 is all about. We have one, costs are what? Recognized when employee and when employees earn them, not when what? Paid. I will explain. And two, liabilities are what? Are recognized when benefits are what? Are owed. Now, what you need to understand on IAS 19 is that when you are an employee rendering service to a firm or a company, they can choose to what? Create and what? Create a fund which the employer will agree with you, the employee, so that the employer will make a regular what? Contribution into the what? Into the fund. So whilst you render your service, the employee will what? Beside your salary that you earn every month, the employer will what? Will make constant or monthly contribution into that fund, so that when you will retire, they will give you that money. Or maybe out of the fund, they can pay your trip to go on holiday. Or out of the fund, they can what? They can take care of your what? Your health needs. Or out of the fund, they can what? They can sponsor your trip to what? To abroad to go and then study. So this is what? Some of the benefits that employees would enjoy under what? Under that what they call that fund. Whilst at it, when you are still with the firm working, say that costs are recognized when what? When employee earn them, not when paid. Which means whilst you are still with the firm and you are working or rendering your service, it is a cost to the what? To the firm. So for that reason, they will also what? Contribute on your behalf into the pool of fund. They will contribute into the pool of fund because you are working for the company is also contributing into the fund for you. It becomes what? A liability whilst you work. You understand? Because the moment you work and you qualify for that contribution, it becomes what? Cost to the company. So when it becomes cost to the company must what? Must pay the money into the fund. Liabilities are recognized when benefits are owed. It means that when you are due to be paid, the company will what? Will have to what? Meet its obligation by paying you from the fund. If the fund is not enough to pay you, the company owes you. That is the meaning. So these are the objectives of what? Of IAS 19. So here, assuming you are what? You are Kofi, you work with this firm, maybe company what? Company A. So the agreement is that you are going to work. You agree, right? So assuming like, okay, they know the number of years that you have left to retire. So assuming like you have 30 years to retire, right? So now you are going to work for the company for 30 years. Okay. So out of this 30 years, they agree that they will make monthly contribution into the into a fund, 1,000 every month. They will pay 1,000 on your behalf into the fund. You understand? So the moment that happens, so every month, if you render service, so service rendered. The moment you render that service, it becomes cost to the company. So the company must pay the 1,000 into into the fund every month. You understand? Now after 30 years, when you are you now qualify to receive benefit from from the fund. They must pay you. So the moment they are supposed to pay you from the fund, if they are unable to meet all the obligation, it becomes liability to the company. So this is the meaning of what you have up there. Costs are recognized when employee earn them, not when paid, and liability are when benefits are owed. All right. We have types of types of benefit. We have types of benefit. Now we have one. We have one short term. We have short term benefit. We have types of benefit. We have short term benefit, and we have what post employment benefit. Okay, so we have post employment benefit, short term benefit, post employment benefit. All right, so these are the two types of benefit that we have. Now when you look at the short-term benefit consists of they consist of your wages that you receive. You have your salaries that you also receive. You have maybe your sick leave that you enjoy, because when you are sick and you take a leave, the company will continue to pay you. So all these things are benefits that comes to you. Or maybe you have a medical or maybe insurance that you enjoy, right? So these are some of the short term benefits, employment benefits what you enjoy. Now we have post employment benefit that someone will enjoy. Now the post employment benefits, they are they are your pension that you receive at the end of your service. And maybe in some organization, after you retire, they can continue to pay your medical bills up to up to 5 years, because I know some company like that. When you retire, they continue to take care of your medical bills for I think 5 or 10 years after you retire. So these are types of benefit, and these are what you enjoy from them. Now in this our lesson, our focus will be on post-employment benefits plan. Our focus will be post-employment. Now, under the post-employment, there are There are two types. So under the post-employment benefit. Post-employment benefit, There are two types. First one is what you call defined contribution plan. And then second one is what we call defined benefit plan. Another defined contribution plan. This one talks more about your contribution to your SNET. So with this one, you the employer will pay a percentage of of your salary into that plan, and and your employer will also top it up to your contribution into into the plan, so that when you retire, they will accumulate the money and give it to you. The second one is defined benefit plan. So that is where IAS 19 is yes, or that's where IAS 19 falls. So our focus will be will be defined benefit plan. So the defined benefit plan, I've already we explained. That one talks about the employer having a guarantee or agreement with the employee, so that they will make a constant contribution into the pool of fund. So example, so if, as I earlier indicated, you hire Kofi. You hire Kofi. Kofi is is an employee, and you agree that you make constant contribution of 1,000 cedis into the pool of fund monthly. Whilst the Kofi in exchange of in exchange of what service that Kofi what will provide to what to the company. You understand? So this is what the arrangement. So at the end of the day, whilst what Kofi works, you also pay into the what into the pool of fund on behalf of Kofi. You understand? So this is what we call defined benefit plan, and defined benefit plan is different from what the short term what benefits such as what salary or wages that you pay to what to Kofi. In all these, how do we what account for the defined benefit plan? How do we account for defined benefit plan? So here comes the what? The format. Here you have what? Fair value plan assets. And here you have what? Fair value plan what? Liability. You underline it. So this is the format, or how to what? How to account for what? For the defined benefit plan. So here you will have here your what? Your opening balance. So your opening balance here, and then here you also have what? Your opening balance for liability. I will explain all of them. And here you have what you call returns from what? From investment. And here you have what? Interest expense. You have what? Contribution. Contribution paid, and here you have what? Service costs. Now service costs, we have two. We have what? Parent what? Service cost. And we have what? Past what? Service what? Cost. Now we here you will have what we can have what we call curtailment. Curtailment can be positive or it can be negative. So here I can put it here or like this. Okay. You can also have what? Curtailment. It can be positive and it can be what? It can be negative. So, and we also have what? So when you are done, then you do what? You do what? Benefit what? Paid. And then benefit paid what will be in bracket. Paid will also be in brackets here. So when you are done, then you sum everything to what we call expected value liability. So we call it what? Expected what? Fair value liability. Here we will have our closing balance here. Now the difference between expected fair value liability and closing balance is what we call remeasurement component. It could be what? It could be negative or positive. Okay, here you also close this, and this one gives you what we call expected what? Fair value asset. Then you have also your what? Your closing balance. And with that one too, you'll have what? The difference between the two will also give you what? Remeasurement component. Okay, it can be what? Positive. It can be what? It can be negative. Thank you. All right, so let me further explain the format for you. What this mean here is that when a company what decides to what create a fund called what defined benefit plan for what for the employees, where they will make what a constant what payment for what for the employees in the what into the what in the firm, you will have to account for the what for the fund, right? So how do you account for the fund? So this is the format for accounting for the fund. At the extreme left, you see fair value plan asset. So this fair value plan asset talks about what the fund created where what the employee would constantly make payment into the what into the fund. So it is what it is an asset to the what to the company. You understand? It's an asset to what to the company that is contributed into it. You understand? So that's what we call fair value plan asset. So once they've created a fund where it's a resource that belongs to the company, so it's an asset. to the firm that is contributing into the what into the pool of fund. Now, when you look at also extreme right, you have fair value plan liability. This one also what stand for what? The liability due to the employees who are going to benefit from what? From the assets. So here, all the what? All the liability or all the service the employees are contributing to the firm. You understand? Will come here. So what this mean here is this. So if you have Kofi, right? Kofi is an employee. So you promise Kofi that you will make a guarantee or constant payment of 1,000 into the pool of fund. So every month you pay. So here, when you pay this into the fund, it becomes assets to the company, what you call contribution 1,000. Now, when Kofi, assuming Kofi, maybe there's a retrenchment and the company decides to lay off Kofi, then it is obligation of the company to pay this 1,000 in the name of Kofi back to Kofi. So that becomes a liability to the company. So that is what we call service that Kofi it becomes service cost that Kofi is supposed to. So the moment the company contribute into the pool of fund, now the company owe Kofi that 1,000. So we call it service cost. So it becomes liability owed to Kofi. That is the idea. That is the meaning of that. That is why you have it left, this one at the left and this one at the right. All right. So that is the idea about that. All right. So that is the idea. So here, the fair value plan asset is is the contribution that goes into the pool of fund, and the liability is out of the moment you create that pool of fund for the employees, this liability will also will be available to the employees. You understand? So while this one belongs to the company, the liability also belongs to the employees. So once you created the fund and the person had worked, you pay it into the pool of fund, then you come and credit the person as under the liability. So if the person worked for it, you come and credit it. It's form part of current service cost. So that is what the person had worked for. So you have to credit it here, as I earlier established or indicated. All right. Now that we've understood about the plan asset and plan liability, let us pick the items one by one and explain to your understanding. Now, there is opening balance. The opening balance here mean that it is a carry forward from the previous accounting year. So here you have it. Maybe in 2017 you have asset amount of maybe 10. Now, when you come to 2018, you have to have asset opening balance. That becomes your opening balance in 2018. So that's why you see opening balance there. So you have to bring the 10. This particular 10 would be in the asset from previous year, the company will not let that money, they will not allow that money sit down. Assuming, so what you have here, example, are this in the expected fair value asset? So this is the total value that you had from assuming the previous year, 2017. So that money will not sit in the account like that. They will invest that money. When they invest that money, the returns that comes with it is what you see here. It's what you see here. Returns from from investments. You understand? So this is what previous year's balance they invested. So the return that comes with it, then they will come and add it here. So now we also have what we call contribution paid. Contribution is a constant payment into the pool of fund. You understand? So if maybe you have 6 employees, so all these employees you pay maybe a constant amount of 1,000 each. So every month you pay how much? 6,000 into the fund, right? So that's what we call contribution paid into the fund. We have what we call curtailment. Skip that. I will explain curtailment in detail. Now, the following one is what we call benefit paid. The benefit paid when somebody qualifies. So you have what? You have Kofi. Kofi qualified, right? Now Kofi had what? Served what? 10 years. So the Kofi qualifies for to receive his what? His benefit plan. How much are you paying Kofi? You pay Kofi maybe 10,000. So that becomes what? Your benefit what? Paid. Now, this benefit that you are paying, it will what? It will reduce your what? Your assets, your pension asset. It will reduce it. The reason why you've seen that it is what? It is in the what? In bracket. It means you are what? It is reducing what? The pension what? Asset. That is the what? That is the idea with regards to that. We also have what we call expected fair value asset. Now, all these pension asset and pension liability, they are not what prepared in vain. They are prepared by who? Actuarial. Actuarial is the one who what brings out the what the insurance what products. Actuarial is the one who define all these. So at the beginning of accounting year, the actuarial will what make this projection for the accounting year, right? So assuming like we are in 2024, so the actuarial will what will say that okay, the company has what a certain amount of what 10 million. Okay, we are going to invest this 10 million with the expectation of what getting maybe 8%. So they are investing this 10 million was in a portfolio that will bring what a return of what 8%. All right. So the actuarial will also say that you have what you have 5 employees. So these 5 employees, the expectation is that all these 5 employees will bring, if they are paying each 1,000, so all of them will bring what 5,000 at the end of the accounting year. So the actuarial will project that 5,000 will come into the into the pool of what of the so that's called contribution paid. Now there's a curtailment here. I will talk about curtailment later. Now the based on what the records that the actuary is having, he has what projected that out of 5 employees, one person what will qualify, right? So he will project that one person will qualify. So he will say that okay, out of so we expect that this person what will benefit. That's called benefit pay, will benefit maybe 1 million out of the money. You understand? So at the end of the day, when you add all these and subtract the benefit paid, the expected fair value asset is what the actuarial will give. So that's what we call expected fair value asset. So all these projections that you will see here will be done at the beginning of accounting year. You understand? It will be done at the beginning of accounting year. So let me give you this scenario. So you have it at the beginning of accounting year. At the beginning of accounting year, the company has pension what asset like this pension asset. Now they have from this pension asset is from what from 2018, right? So 2018 they have balance of maybe 5,000. Okay, so you come here, then the actuarial will say that okay, we have opening balance of 5,000, so that will give a balance what brought forward. So that is what balance brought forward of what 5,000. And this actuarial say that okay, in the year 2019, we are going to invest this 5,000 in what? In 8% what? 8% investment portfolio. So okay, so 8% of this one will give us investment what? Investment returns. So how much is the return? Okay, 8% of this will give us how much? 5,000 will give us how much? Let me do it. So you have point times 5,000. Okay, that gives you what? 400. So this what actuarial what projected that the company what will benefit. Okay, now contribution. So actuarial projected that okay, you have how many? You have 5 workers, and the company is paying each work. You have 5 workers. Okay, and then there is a guarantee of what paying each of the worker. Let me say 500 cities into the pool. So 5 multiplied by 500 will give us how much? 2,500 like this. Okay, so this is what you have in the pool. Now, the actuarial also projected that one person will qualify. That's what they call benefit what paid. So at the end of the day, one person will qualify. So how much is the person getting out of this? So the person will also get 3,000. Yeah. You put it in brackets. So when you add it, this is what you call expected what fair value. So when you add it, or what do you have? So this is what the actuarial actually what did for us at the beginning of accounting year. So this is what the actuarial did at the beginning of accounting year 2019. Okay. At the end of accounting year, this is what actually happened. So this is what we call actual. So this what you've seen here. So what here? When we are doing IAS 19, I try to explain. So what this and that I have done here, they are what? They are projections by what? By the actuarial. Now let me demonstrate the actuals. What actually happened? We have this balance, opening balance. Okay, this is our opening balance from the beginning of accounting year, which is what 5,000. Now the actuarial said that they are going to invest this 5,000 into an 8% what insurance company. So when he went, something happened at the end of the account. Something happened, and so we couldn't. You understand? We couldn't get the 8%, though he went and locked it up. So within the period, something maybe economic downturn or something happened, so we couldn't get 8%. So out of it, we get what? We got what 5%, which is what 5%. So we calculate what 5% on what 5,000. That gives us what 250 contribution. Okay, every employee is going to what is going to get what 2,500, right? Okay, so that one will come 2,500. Now they evident that one person will leave, which is what benefit what paid. So when you less that one, that gives you what? So let's see. Closing balance is 4,750. Right, so this is what you call closing. This is what the actuarial was projected, and this is what actually what happened. So this comes here, closing what balance in the books. So you will bring your closing balance here, 50. When you are doing IAS 90 in a question, the actuals that I have demonstrated here, they will give it to you in bulk. They will not ask you to do what I have done here. But for the purpose of education, I try to explain for you to understand how they arrive at the closing balance. This is the closing balance. So you ask yourself, the projection that the actuarial did for the company was 4,900. But the closing balance, it means what actually happened is 4,750. Is it a loss to the company or gain to the company? It's a loss to the entity. We call it what? Remeasurement what? Remeasurement component.
No, 4,7 is the closing.
Remeasurement component.
Okay.
So the difference is how much? It's a loss to what? To the company, which is what?
Cost.
150. You can put it in bracket, or you can what? You can decide not to put it in bracket, but write beside it what? Loss.
4,007.
You can either put it in what? You can decide to put it in bracket, or you can what? You can leave the bracket and then
Yeah,
write
please give
beside
me
it what?
some clarification on it then.
Loss, like that. You can write beside it loss, like that. Watch here. This is what the actuarial belongs to the company. This is what he planned for the company at the end of the accounting year, that their asset value is going to be 4,900. But at the end of the day, and I told you that actual, it's like budget. You are doing budget. It's like you are doing budget. Your budget and your what? Your actuals. And you have your what? Your variance. You budgeted that, okay, you have revenue of more than 2,000. At the end of the day, you had what? 1,500. You have what? Negative variance of what? 500. The actuarial belongs to the company. He will do the projection for the company. So this is what we call expected fair value asset. So
Yes,
he planned that he will get 4,900 as an asset on behalf of the company in the fund or pool. At the end of the account, the actuals, what really took place happened, gave them what? 4,750. So is it a gain or loss? You understand? So they plan to get 4,900. But at the end of the day, the closing balance is 4,750. So is it loss or gain? The 4,900 is what? Is the projection from the actuary, just like a budget, right? Now the closing balance is the actual. So the difference becomes your measurement component. Now, when you look at the actual as how much is projected, you see that the balance, closing balance is less than the what? The how much is budgeted to what? To obtain another asset. So it is a loss what to the company. You understand now? So that is the explanation to what? To the fair value asset column. Now let us go to the what? The fair value liability column. The fair liability column here, the opening balance means that what here? The opening balance and the liability means that in the previous accounting year, the company have what? Expected fair value liability, or maybe the closing balance of what? The opening balance for liability came from what? From the previous accounting year. Means the opening balance means that maybe the company owes what? The workers maybe 50 million liability yet to be settled. You understand? So far as you have what? You created an asset and you pay money into it. At the credit side, you what? You will have liability to also settle. So this opening balance from what? From here means that it's a liability to what? To be paid to what? To the employees who will qualify in the near future. So example, it could be like this. Example, if the company have what? Closing balance. Watch here. Closing balance assets of 5,000, 500, and they have what? Closing balance liability, maybe 600. So clearly you can see that the company asset is what? Is less than what? The liability it has to settle. So when you decide to pay all the liability, you can only pay 500, and you have what? Balance, which is what? Pension balance, pension liability balance. You understand? So
Perfect.
you have what? Pension liability balance of what? Of 100. So you take this one to
Yes,
the
sir.
next accounting year. You understand? So that is why you will have what? You have what? The opening balance liability here. Now, this opening balance in accounting, when there's a liability owed to people, it attracts what? Interest expense. You understand? It attracts what? Interest. So yeah, you will charge interest on the what? On the liability that you owe to the employee. So that's where you have what? The interest what? Expense here. So if you have what? 100 CDs here, they will give you cost of capital. So the cost of capital that you've invested your money, if it is 10% that you are going to get it as a return from your balance you invested, the same 10% will attract your what? Your interest expense here. You understand? Because at the end of the day, this money belongs what? To the employees. You calculate the what? You calculate what? The interest spent on the what? On the liability as you have it there. Now, when you are done, let me explain below items also to you. The first one, current service cost. Another current service cost. So current service cost is what? Is the what? Is maybe if maybe you engage an what? Employee. So maybe the contract is 20 years, and what? You make what? Constant what? Contribution into the what? Into the fund on behalf of the employees, maybe 100 cities every month, monthly. What do you do? So at the end of the day, it is expected that you what? You pay this what? This 100 CDs into the pool of what? Account. So every month, if every month you are going to pay 100 CDs, 1 year, one accounting year will be how much? Will be 1,200. You understand? So this is what you are expected to contribute into the pool for that what? For that employee. So each year you have to what? You have to pay 1,200. So that is what you call current service cost. Well, since the person is rendering service to you and you've created what? Pension plan for the person, it's expected for you to contribute 1,200 into the pool. So once the pension asset is receiving the money as contribution, you see that the pension liability, it will go under the pension liability as what? As current what? Service cost. So if it is 1,200 here, then the current service cost qualified to receive 1,200 here. That is the meaning of what? The current service cost in here, what you see here. Now, let us look at the second one is what we call what? Past service cost. Now, under the past service cost, that is the arrangement. So under the past service cost, assuming you engage what? An employee. So arrangement, the person is working maybe 20 years. Now, you decided to what? Make a contribution for that person. How much are you paying? 100 cedis monthly. So a year, the person will receive 1,200. You understand? So that is the arrangement with what? With that person. So every year, it's expected that you pay what? 1,200. If something happens to this very arrangement, the 100 monthly contribution into the pool, when something happens to it, that is where the past service cost comes in. It could be what? It could past service cost gain or past service cost what? Loss. It could be gain, it could what? It could be loss or it could decrease. Okay, so this is the kick. So you've engaged the person that you give the person 100 cedis every month. Okay, so along the line, three things can happen. These are the things. One thing that can happen is what? Introduction of what? Of new defined benefit. Or maybe you are amending the what? Existing what? Plan. Or you will say that you are doing what we call curtail plan. So the curtail plan will also what? Affect this. Now, I mentioned that I will speak about curtailment. So when these things happen, it affects the what? That is where the past service cost comes in. So let me give you this analogy. So here you engage this employee. So the monthly, you decided that monthly you give the person what? 100 cedis. So yearly it will be what? It will be 1,200. Along the line, you said that okay, something has happened. So your monthly contribution is now going to be what? 120 cedis. You understand? So every year you are paying how much? How much are you giving the person every year? So if it is 1,200, how much are you paying that person every year? So that will be what? So every year you are paying the person 1,440. So have you seen that there's a difference? So the difference is what you call past service cost what? Gain. So how much is that? So the difference is what? 200 and what? 40. This is what you call past service cost. You understand? So that is when there is an amendment to the what? Into the what? Into the what? Service. As I've already what? Explained here. I believe you've understood. I believe you've understood. So that's what we call past service cost. Now that we've understood what past service cost is, let me also talk about what we call curtailment. Curtailment can happen. Now, curtailment can happen when there's what we call significant. When there's a significant what? Reduction in what? In the number of what? Employees. That's where curtailment comes in. You understand? So actuarial plan that you already have existing how many? 10 employees with the what? With the company. You have 10 employees working with what? With the company. You understand? So you have 10 employees working with the what? With the company. Now, you have these employees are working, there's no problem. Along the line, maybe middle of the accounting year, the company decided to what? Discontinue 3 workers what? 3 employees contracts. The company decided to discontinue what? 3 employees contracts. So when that happens, what happens? It will affect your what? Your contribution into the pool. You understand? So when that happens, what do you do? So now you have what? 8 people working. So 7 people will be working. The 3 people will be sacked. So when you are going to sack these people, you pay them what you call severance. You understand? Before you lay them off. So The company decided that, okay, you have to come and settle, you have to settle these what employees. So when you are settling them, how much are you settling? How much are you supposed to what, settle them? So you are supposed to settle them maybe 50 million. 50 million. So out of negotiation, now you agree, they agree with you, the tribal agree with you to pay them what? 45 million. Now, have you seen that there's what? There's a difference of what? 5. So it is a gain to what? To what? To the company. This is what you call what? Curtailment. You understand? This is what you call curtailment gain. You understand? Now, how about if maybe initially the agreement is that in actuarial estimation, the actuary estimated that, okay, when we are sacking this employee, then we are going to pay them severance, or we are going to what? Pay them that severance or redundancy fee. Redundancy. We are paying them, the actuarial envisages that they are going to what? Pay them what? 50 million. But at the end of the accounting year, you ended up what? Settling them how much? 60 million. You see, there is what? There's a 10 million what? Loss what to the company. This is what we call what? Curtailment. I believe you've understood all these analogies. So that is what this curtailment, as you see it here, mean in the what? In the format. Now we have benefit paid. So the benefit, I've already explained it. We have expected liability. So now let me take this one once again, and then use that one to what? Explain the pension liability. So now you have what? Pension what? Liability coming from the previous accounting year. Pension liability. Now, when you have pension liability, you have what? Your balance brought down from what? From the previous accounting year, which is maybe 5,000. The actuarial said that, okay, since we are going to make an investment returns from what? From our assets, then we are going to what? We are going to earn 10%. So if you are going to earn 10% on your pension asset, so that is the investment portfolio that you want to invest. If so, then the pension liability will also be attracted same. So you have your what? Your interest expense of what? 10%. Yeah, so you calculate 10%, that gives you what? 500. This accounting year, the workers what? Provided service. So you have to pay them what? Current service cost. So you are paying what? Current service cost, and which is maybe 4,000. Now, past service cost, there's what? There's a possible change of what? Some of the agreement with regards to contribution for salary, it cost the company. So past service cost is maybe 1,000. Now there's a curtailment. There's a what? There's a curtailment. Curtailment loss to the company. If there's a curtailment loss to the company, it increases what? Liability. Maybe curtailment loss was 200. Then you bring it here. Okay, so at the end of the day, they paid what? Benefit. The actuarial what? Said that they what? They will pay benefit. Okay, so how much are they paying benefit? They are paying benefit of maybe 3,500. Okay, so this is what the actuarial did at the end of the accounting year. At the beginning of accounting year, sorry, this is what the actuarial did at the beginning of accounting year. You have what? 5,000. We have 5,000 liability to be settled coming from the last year. The interest on it is 500. Okay, till my current accounting year, you said that you have what? 5 employees working. Their total contribution is going to be what? It will be 4,000. So it has also been credited under current service cost as 4,000. Now, past service cost, there's a change or amendment made, so it also affected what? Your liability. It increased your liability to what? To be 1,000. And now there's a curtailment. You envisage that there are some curtailments that the company has to what? Has to settle, because along the line you laid us on some people, so there was a cost to the company. So it will increase your loss here. Then you add it. Then you envisage also said that you pay off some people. One person will qualify, and the benefit the person will going to get is what? Is 3,500. Now, when you sum them and you less, what do you have? Okay, so at the end of the day, this is what expected loss to the company is what is supposed to be. So this is what we call expected what? Fair value what? Liability. So this is expected what? Fair value liability from us. So this is what the actuarial did at the beginning of accounting year. Now, let's look at the actual, what actually happened. The opening balance brought down. Yes, it is 5,000 coming from the previous years. Okay. Now, the interest didn't change. So we pay the interest of what? Of 10%. So that gives what? 500. Now, the current service cost. We expected to pay 4,000. We ended up paying 3,500 because something happened, because we laid off some people. So it will reduce your current what? Service cost. Now, past service cost remain the same, 1,000, right? And the curtailment also remain 200. Now, the benefit paid also remain 3,500. Okay, when you add it all, what do you have? You'll have what? 6,700. So this is what you call your closing what? Balance. This is your what? Your closing what? Balance. So this comes here. So this is what have you seen that? Have you seen this is what the what? The actuarial what? Project, and this is what actually what happened. So this becomes your what? Your closing balance at the end of the day. So that's why you have what? 6,500. So the difference between this one is what we call remeasurement what? Component. Now the remeasurement component, is it a gain to the company or loss to the company? You expected to pay off 7,200. You ended up paying 6,700. Is it a gain or loss to the company?
It will be a gain to the company.
Thank you very much. So it will be a what? Gain of what? 500 like this. So when you are done, you can leave it like that, or you can say gain. You understand? Because when you put it in brackets, when you reduce it will give you 6,700. Or you can just put it in brackets, you can choose to leave it and you write gain beside it. So that is the idea about the accounting for what? For the now let me finalize one thing which we call asset ceiling. Now, when we say asset ceiling is what? Is a limited amount or limited surplus in what we call what? Defined benefit plan asset. That can what? That can what? Can be what? Recognized in the what? In the what? In the statement of what? In the statement of in the financial what? Financial what? Statement. So what happened? What am I saying here? This asset ceiling applies to only defined pension plan, right? So asset ceiling, it affects only what? Pension asset. It only affects pension assets. How does it happen? So they can what? They can set a limit. So assuming you have it here, where is your pension asset? Okay, let me do new one here. So assuming you have your pension asset here. Assuming you have pension assets. So maybe you have what? Your opening balance. You have your opening balance to be maybe 100. You have your what? Investment returns, which is maybe 10%. So that gives you what? 10. You have your what? You have your contribution. It's maybe 200. And then you have your what? Your benefit paid, maybe 150. Right? Okay. So when you add it, that gives you what? Expected what? Fair value what? Asset. When you add it, or what do you get? 160. This is the what? This is the expected what? Fair value asset. So so now this is a fair value asset, and then they told you that the closing balance. Listen, they say closing balance of what? Of pension assets. In the question, they say closing balance for the asset is maybe 500. This is what actually happened. Now it is 500. Then in the same question, they say that the asset ceiling should be 350. That means you are not going to use this what? You are not going to use this what? It means you are not going to use the closing balance of this 500. Because they've already told you that the asset ceiling, it means the maximum amount the closing balance will be in your book should be 350. Asset ceiling is what? 300 and what? 350. So this is what you are going to what? Because at the end of the day, you have for the closing balance of 500, and they say that their asset ceiling is what? Is 350. So your closing balance would what? So this why you will bring your what? Your asset ceiling here being what? 350 here. Please have you understood? Then you come and find your what? Remeasurement component. The difference between this one, because this one you expected that you had it, so this is a gain. So the difference between this one and this one will give you what?
190.
190. So this is what? This is a gain to the company. Now, when you are done, then you come and find the what? The closing balance of what? Of the asset ceiling was what? Was 500. Closing balance of assets is 500. And then they said that the maximum you can what? You can recognize in your what? In your book is what? Is 300 and what? 50. Now the difference between this one and this one. So this what we call the unrecognized. The difference between this one and this one is how much, please?
Say 150.
So we call it what? Unrecognized what? Surplus. Simple. 150. All right. So that is the asset ceiling for you. And how come do we have this asset ceiling? If the one that is contributing can what may have what contributed more than they are expected to what contribute, it can increase your what your closing balance figure. So when it increases, your closing balance will increase that much. You understand? It will increase your closing balance. That could be as a result of what of that. So these are the thing that you need to know. So that is it about that. So I've explained all that you needed to know under the IAS 19. Okay, so now watch here. You will never know. Watch here. In most cases, when they are asking you question under there, but have you seen this formula? Have you seen this formula? The format. Have you seen this format? So this is the what? This is the standard format that you must know. Please, are you with me?
Yes, sir.
So this is the normal format that you must know. But however, at a point, a question will come that will not require you to use the two fair value plan asset and fair value liability to do your computation. You are only expected to prepare a single format. You see that the above was the double, right? So the single format, in most cases, it comes with only pension liability plan. So they will give it to you in the question. They will tell you that maybe in the previous accounting year, the closing balance, the balance for the asset, you see, it will come in that form. They will make it in that way that they expect you to prepare only pension liability alone, because the information that are available will only allow you to prepare only the pension liability. How does it happen? Maybe in the previous accounting year, the closing balance for the assets was maybe 100. Closing balance for the liability was maybe 200. Clearly, there is a lot to pay, but you have limited resources. So you can only pay 100. Then you have what you call the balance will be will be pension liability in your books. So when you start the new accounting year, which is 100, when you start the new accounting year, you only have pension liability left in your books, right? So here in the question, the expectation that they will expect you to maybe use the pension liability alone to prepare. And this format that you see over here, the two of the format, we can make it single. You understand? We can make it single format as well, and it will give you the same answer. Do you understand? Okay, so let me demonstrate it here for you so that you know that when you are confronted with such question, you know what to do. Okay, so assuming you have a question like this, you have your pension assets, you have your pension liability, right? Okay. So you have your what? Your opening balance. Here is what? 100. And then opening balance here is what? 150. Take note of that. Now, they said that the interest return is what? Is 10%. So here you will have your what? Your investment returns. So 10% of this one will give you what? 10. So the same applies here. So here will give you what? Interest expense. So which will also give you what? 10%. So here will give you how much? 15. Now you have what? Contribution. All right. So contribution is what? 200. And here they said what? Current service cost is current service cost is, let me say, 50. And then past service cost here is maybe 20. Okay. So here, curtailment happened. So the curtailment that happened was, let me say, negative curtailment happened. So it will increase. So you can bring it here or you can bring it here. It will give you the same outcome. So if curtailment is a gain, what? If the curtailment, maybe there's a curtailment gain of maybe 10. If it is a gain, when you take it here, when you bring it here, you open bracket. But when you bring it here, because it is a gain, it will reduce our what? Our liability. So you put it in bracket. So wherever you put it, but it should appear either here once or here. You understand? So if you are preparing the two, okay. So I will what? I will leave it at what? At the assets. So get the payment. I open the bracket. Good. Now there's a benefit paid. So you paid benefit, or so you expected that you pay benefit of maybe 150. So if you are paying benefit, here too will be the same 150. Okay. So please let us add them. So this is what the actuarial calculated to what, so expected what, so expected what, fair value what, asset. Okay, liability is how much?
So 85.
Okay, so here is 85. Good. Okay, please make this place add 200 here. Make it 250, eh? Then you increase it. So here will be how much?
Okay. 285.
285. Good. Now, in the question, they told us that closing balance for asset. Closing balance for asset, closing balance. They will give it to you in a question. Closing balance for assets. Here is what? 200. Closing balance for what? For liability. Here they say it was a 300 and what? 50. Okay, so let us close it. So the difference between, let's look at the asset. Is it gain or loss? You expected to what? Get 170. Now you ended up getting what? 200. Is it gain or loss?
It will give you a gain.
So that's what we call remeasurement component. Now, so this remeasurement component, the difference is how much? 300. So this is gain. Now let us come to what? Liability. You expected to what? Incur what do you call it? A loss of 285. You ended up incurring what? 350. Is it gain or loss?
It's also a loss.
So here is what? A loss. So here we give you what? Remeasurement what? Component. The difference is how much?
65.
65. So this one is what? Loss.
It's a small.
We can do it in what? In the single format. We can do it in the single. We can do it in the what? In a single format. So if you are doing it a single format, this is what you will do. Please look at the what? Look at the opening balance. Which one is what? Is the higher value? Asset and liability. Which one is the higher value?
Liability.
Okay, so liability is the what? Is the has the highest opening balance. So you will come here, you do what? Pension what? Liability. You have your what? Your opening liability. Now liability is the one with the highest value. So when you come here, then you come and do your what? Your what? Your opening balance. Your opening balance. You will pick the asset. The asset is how much? The asset opening balance is how much? 100, right? And then
100.
the liability is how much? 150. So you pick down, you pick what? The liability 150 minus what? Minus the 100. How much do you have? You have what? 50.
You have 50.
You understand? So now, once you have it that way, you are good to go. Then you will come here. Then you will what? You will bring your what? Your interest expense, which is what? 10%, right? 10% of what? 50 is how much? It's 5. Is that not the case?
Yes, sir.
Now you will pick all the items under the liability. The second one is how much? Current service cost, right?
Yes, sir.
Current service cost is how much? It's 250. Power service cost is how much? Power
Power
service
service
cost is
cost
how much?
is 20. 20.
Power service cost is what? Is 20. Then you'll bring it, right? When you are done, then you go to what? You go to the contribution. You pick contribution because you pay this liability from a contribution. And the contribution is how much?
It's 200.
Then you put it in bracket because you pay contribution out of what? You pay your liability out of contribution. The only item, so that's the item that you will bring here. So when you are done, there's also what we call curtailment what? Gain there. So you will bring that curtailment. And because it's a gain, you also put that one too in what? In bracket because it will reduce your what? Your liabilities. How much? It's 10. Don't bring benefit paid. That's all. I believe you understood. So when you are done there, you add them all. What do you have? Because
Okay.
it will be paid through what the contribution that you brought there. So when you add it, what do you have?
115.
Expected what? Fair value what? Liability.
Expected like
The closing balance. You will pick the what? The asset. The closing balance for asset is how much? 200. And the closing balance for liability is how much? 350. When you less, what do you have? It will give
we
you
are going to
150,
get
right?
minus 150.
So now you compare the two. Is it gain or loss?
It's a lot, sir.
A loss of how much?
35, sir.
Okay, all right. So here would have been 30, right? Okay. So here, so this gives you what? Remeasurement what? Component. And you said it's what?
It's a loss.
It's a loss. Take note
Yeah,
of what we have done
small,
here.
small, small, small.
Take note of what we have done here. I will refer you to the first one that we did, and you will see something. When you are done, watch here. When you are done, there are things that you watch. There are two things that you will pick out from your calculation. One, you will pick out from what? Remeasurement component, which will go to P&L. Do you understand? Then you also pick up what? The balances. Do you understand? The balance, whether it will be pension asset or pension liability balance. So before you determine that one, you will go here, you will compare the closing balances. Closing balance for what? Asset and closing balance for liability. Which one is higher?
The liability is higher.
Good. So that means we cannot pay all our liability because the asset is small, more or less than what the liability. So here, so then that means the item that will go to P&L will be what? Will be a profit and loss account and a of financial position. First one is remeasurement component, and the second one is what? The pension liability, because you said that is pension liability is more than the pension asset. So here will be pension what? Liability. You understand? So how do we get it? So you will pick the what? You will pick the pension liability, which is 350. Then you will less what? The pension asset, which is for 200. So the difference will give you what? 150. Is that not the case? So this one
Yes,
will
sir.
go to what? Statement of financial position. And the remeasurement component. Also, when you come here, whatever you will get here, you add it. You add the two. You add the asset and you add the what? The liability remeasurement component here. Okay. So when you add it, what do you have? You have first one, you have what? First one is what? Positive what? 30. And then the other one is what? Negative what? 65. Is that not the case?
Yes, sir.
One is gain and one is loss. So when you add it, what do you have?
35.
So that will give you what? 30, 35 negative.
Right.
Have you seen what I have done here? Now, compare it to the single one that we've done. Compare it to the single one that we've done. Look at the remeasurement component. Is it a loss? Is that not the case?
Yes.
A loss of how much?
35.
Can't you see that the same thing is here?
Yes, sir.
And then the closing balance, 150. You see that one too is there here, right?
Yes, sir.
Good.
Yes, sir.
So that's what I'm drawing your attention that you can do it single or you can do it what? Double. But in most cases,
No.
if they are what they want to test you, understand how to derive the value from from pension liability. Okay, so here when you are done, this is what you are coming to do. You are not coming to do your extract. Now your extract, these are the items that will come to your extract. You will have your one. You will have your your investment returns. How much is your investment returns? Your investment returns, when we do the calculation, how much? It's 10,
We
right?
are 10. Yes,
Okay.
sir.
Now your interest expense, how much?
Interest expense 50.
50. That one
50. 1 5.
1 5 15. So because that one is what? Expenses, you put it in bracket. So when you the interest
Yes,
returns
sir.
and interest expense, when you find the difference, it will give you what? It will give you what? Net what? Interest, which is how much?
-5.
5. Now come here. When you pick the single one,
Neg 5.
when you do the single one, have you seen that the interest expense is what? Is 5. Have you seen it? The same, the same.
Yes, sir. Yes,
You
sir.
understand? It's the same. Now, so
Yes,
that
sir.
means when you want to pick the values from what? From the pension liability, it will give you the same outcome when you pick it from what? From the double format. Do you understand? Okay. So after
Yes,
you are
sir.
done with what your investments and then interest expense, then you will come here, you will pick your what? Your current service cost.
Current service cost.
Current service
Current
cost is
is
what?
250.
250. You put it in bracket. Then past service cost is how much?
20.
You
20.
20. You put it to what? You also put that one to is in bracket. Then the curtailment. The curtailment, is it gain or loss? It's a gain. It is what? Gain 10. You open bracket. So we are done. So when you are done, then you come and do your what? Your OCI, other comprehensive income, which is what? The remeasurement components we are talking about. Will come under what? Will come other comprehensive, which is how much? The remeasurement component, when we did it, how much is when we added the two
Negative
negative, it gave it 35.
35.
So when you are done, then you go to your what? Your statement of what? Financial position. So statement of financial position, you will have your what? Your pension liability that we've done. So you'll bring it. How much is it? Pension liability is
Pension
150.
150.
Now, then you come and open your what? Your equity. So under your equity, you will bring your what? Your other reserve. Because there's what? There is other comprehensive income. It will have corresponding entry in the equity. Do you understand? Have you understood other
Yes, sir.
comprehensive? Have you
Yes,
do
sir.
you remember? Aha. So you once you open, you have your other comprehensive income. It will have corresponding entry in the what? In the equity and the other reserve. Okay. So that is it. That is it about that. Any question, please?
No questions, sir.
All right.